Hi, this is the Encyclopedia program. Let us explain that anyone can become a millionaire through a financial plan. Whether you are a student or already working, no matter whether you have savings or not, you must learn about financial management. Financial management is management of life. When you really learn, you will agree with this concept. Like me, I started to learn financial management in 2021, and I am still learning. Learning to manage financial management, in addition to outperforming inflation, the more reward is the change of thinking mode. For example, in order to raise geese, I learned control desires and stop buying, and learn to delay gratification. For example, when doing things, you will have a longer-term plan, not only thinking about the optimistic side, but also considering how to deal with the worst result if it happens. Said, from the beginning of the day when I watched the market. My mood fluctuated with the ups and downs, and now I insist on investment strategies to watch the market once a month. I have learned to face up to risks and fear the uncertainties of the world. 1. Starting from changing the concept of consumption. Yes, the first step is not to learn how to buy fun stocks right away, but to change your consumption concept first. I once read an article about a beautiful girl who often cut down on food and clothing and used the money she saved from eating pickles to buy very expensive cosmetics. Go buy expensive bags. Well, if you have the same income as the stock god Buffett, you will lose it very quickly. Therefore, the first step in learning about financial management is to change consumption concepts. After all, Moonlight has never been able to buy any wealth management products. You have to have money before you can invest. Many spending behaviors are impulsive consumption, and the less flexible saving method will restrain your consumption desire and achieve the purpose of saving money. Therefore, we have to learn to keep accounts. Bookkeeping is not for keeping a running account, but for analyzing your past consumption behavior. You can know which things you don't have to buy, and you don't need to rush to buy them. This is very important for guiding future consumption in the future. After that, save money in a planned way and gather sand into a tower. At the beginning, start by saving 10%, and this ratio will gradually become 30%, 50%. Later, you may be able to save 90% of your income every month and only spend 10%. 2. Understand various investment products and their risks. Let me talk about investment first. The first and most important principle: don't touch what you don't understand. Don't touch if you don't understand. Don't touch if you don't understand. Let's talk about the characteristics of common investment products in detail. The mode of operation of the monetary fund is roughly like this. The fund company pools everyone's money and uses it to buy bank time deposits and large denomination certificates of deposit. Because the amount is large, depositing in a bank is definitely different from our small depositors depositing tens of thousands, so we can negotiate with the bank to get higher interest. Because the main investment direction of the currency fund is bank deposits, it is very safe. The reverse repurchase of treasury bonds is essentially a short-term loan. Everyone knows about borrowing. The reverse repurchase of national debt means that the company urgently needs money, so it uses the national debt in its hand as collateral, and you lend the money to him, pay him back the national debt. Because the supervisor is the National Financial Institution Department or its affiliated companies, the risk is extremely low. At the end of the month, the end of the quarter, and the end of the year, companies need money urgently. At this time, the reverse repurchase rate of government bonds will be very high. If you have spare money, it is also great to save for a few days. Bonds can be divided into national bonds, local government bonds, and corporate bonds according to different borrowers. In short, the state, local governments and enterprises borrow money from the people, agree on a repayment date, and pay the principal and interest when due. The country and the government borrow money. Of course, the risk is very low. The interest, of course, is also very low. Funds and stocks are the most familiar to friends, but many people actually don't know what the mechanism behind the rise and fall of funds and stocks is. Let me give a simple example to help you understand stocks. Mark wants to open a stationery store and needs 100,000 US dollars, but he only has 50,000 US dollars, which is not enough, so he comes to you to borrow money. You lend him $50,000 and say, you don't have to pay back the money, but if you make money in the future, half of the profit will be mine. Of course, if the stationery store closes down, you won't be able to get the money back. So you become a shareholder of this stationery store, accounting for 50% of the shares. Simply put, when you buy shares in a company, you become a shareholder of the company. Whether you can make money from this company's stock depends on the company's operating conditions. But you don't know which company's stock to buy. What should you do? At this time, a person appeared, and he was the fund manager. The fund manager said, I have rich investment experience, let me help you buy. Funds are divided into different types according to different investment directions. Stock funds are used to invest most of the money in stocks, and bond funds are used to invest most of the money in bonds. Because of the different attributes, the risk of the bond itself is lower, so the risk of the bond fund is also relatively low. The risk of the stock fund is relatively high, because it is still buying stocks in essence. Stock funds also include index funds for passive investment and active stock funds for active investment. You can buy them in some securities companies or investment banks. Buying them is equivalent to buying a basket of stocks selected by a fund manager for you. As for winning or losing, it depends on how the fund manager is selected. If the broader market falls to a very low point, the index fund will also fall. The core of our value investing is buy low and sell high. Buy when the stock price is low and sell when the price is high. The economic downturn is a good opportunity for investment. If you find it troublesome to research stocks, you can buy some index funds. As long as the economy continues to improve in the future, long-term returns, 5 to 10 years, must be good. You can regularly invest in some index funds as long-term deposits. Wait until the economy picks up before collecting time compound interest. In addition, crude oil futures, precious metals, and industrial collectibles are all extremely risky investments, and friends who don't understand should not try it lightly. 3. Learn investment knowledge well. As mentioned earlier, if your risk tolerance is relatively low, then put your money in monetary funds, buy bonds, and buy a reverse repurchase of government bonds. It is almost impossible to lose money. But if you are not satisfied with the income that is only a little higher than the bank interest rate, then you have to study hard. The more common investment methods are of course buying stocks, funds, and bonds. Let me tell you about their simple logic. The previous part explained the operating mechanism of the fund. The key person in it is of course the fund manager. Therefore, if you want to take the initiative to buy a fund, you must first look at the past performance of the fund manager. Note that you can't just look at the history of this fund, because it is possible to change the fund manager of the same fund. If it has performed well in the past, it may also be because the fund manager was good last time. Maybe it will be cool to change now. In addition, it also depends on the size of the fund. Try to choose a larger fund company. Let's talk about stocks. As mentioned earlier, buying stocks is actually buying the company behind the stock. Stock returns can be roughly divided into two directions. One is shareholder dividends. Just like the example of the stationery store mentioned above, as long as there is a profit, part of the profit belongs to the shareholders. The other is the benefits of buy low and sell high. The efficient market hypothesis holds that the price is reasonable, that is, the company's stock price reflects the company's value. But in fact, certain factors can cause the value to be undervalued or overvalued. Investors can buy when the stock price is lower than the company's value, and sell when the stock price is higher than the company's value, so as to obtain intermediate profits. It sounds a bit abstract. Let me give you an example. For example, you usually have the habit of drinking mung bean soup, and often go to the supermarket to buy mung beans. Suddenly one day, someone claimed that mung bean cures all diseases, so the price of mung bean in all supermarkets skyrocketed, from the original price of $10 for 500 g to $100 for 500 g. Are you willing to spend $100 to buy it? After a while, someone claimed that drinking mung bean soup would make you sick, so the price of mung beans plummeted to $1 a caddy. Would you buy it for $1? The basic principle of value investing is the above logic. If you know that mung beans are just an ordinary food, neither a cure nor a disease, and it is only worth $10, you will not buy impulsively. If it is a company, many people don't understand this truth. When the price of mung beans, stocks, rises, they think that the price has risen so fast must be a good thing, and when the price falls, they want to sell it quickly. Think about it. Do some securities companies and banks often introduce stocks/funds that have gone crazy in the past month? It takes a lot of homework to judge whether this stock should be bought or not. For example, to judge the development of an industry, because some industries are easier to make money than others, profitability and so on, it also depends on its core competence, whether its profitability is sustainable, whether it will close down after 2 days of opening, or it can survive for a long time. Peter Lynch said that investing in stocks is a combination of art, science, and research. It is difficult to obtain good returns only by analyzing financial reports, only looking at the market, or just relying on intuition. The investment with the lowest risk in the stock market should be new stocks. Before the new shares are issued, you can apply for the stock first. If you are lucky and win the lottery, you can make a small profit by selling it when it is released. In particular, I want to remind everyone that history cannot completely predict the future. A good investment strategy is like tossing a coin. Others' coins are 50% up and 50% down. Your coin is special. It may be 60% up, earning, and 40% down, losing. In terms of time, such as 5 to 10 years, you have made money, but it does not guarantee 100% profit at any time point. 4. Investing in yourself is the highest return. If you learn to invest, the annualized return can reach 30%, which is already a super high rate of return. However, if you can improve your ability through learning, the growth rate of income will be much faster than 1.3 times. Learning to manage money can increase your income, and investing in yourself can increase your principal. Financial management as a skill follows the same laws of deliberate practice as learning any knowledge. Learning more, practicing more, thinking more, and discussing with people who are better than yourself are all ways to improve the learning effect. As I said at the beginning of the article, my study of financial management is more of a harvest at the thinking level. I have always felt that the most important thing is growth rather than accumulation of wealth. Whether I am doing work, financial management, or writing, it is a process of self-exploration, in order to make myself more mature. Learning to invest is to avoid risks, but also to face up to risks and fear the uncertainties of the world. Having said that, some people may still ask some questions. Do you want to invest? Low income, how to invest? Below, I will simply answer. 1. Do you want to invest? Anyone should not only invest, but also earnestly study professional investment knowledge. Many people around us get wage income by going to work in the company, but this income is limited, there is no scale effect, and it is difficult to realize wealth appreciation through work. Also look at the rich people around you. Basically, they started to achieve financial freedom through investment and entrepreneurship at a very young age. It is difficult to achieve this by relying solely on wages to accumulate wealth. 2. If the income is not high, is the investment still meaningful? We should look at investment from the perspective of a person's life cycle. From the beginning of work to the complete retirement around the age of 70, the investment time of a person is about 50 years. Investment activities in each age group have their importance. It's like 20 to 35 years old, These 15 years are the initial stage of personal career, with low income and less wealth. However, people in this age group have a strong tolerance for risk. Even if the investment loses more than 100,000 to 200,000 yuan, the big deal is to start all over again, and it will not cause irreparable losses to life. In addition, when a person is young, he has a strong ability to learn and understand, which is a good time to learn and understand investment. Maybe you won't make much money in these 15 years, but if during this period, you can truly understand the attributes, pricing methods, and cycle characteristics of various financial jobs, be familiar with basic trading techniques, and understand the development of major industries and companies. A relatively clear understanding of history, and business models will lay a solid foundation for investment activities after the original capital has accumulated to a certain level in the future. So if you are still very young, at this age, don't worry too much about investment returns, and focus on learning and practice, so that you can get rich wealth in the future. 3. For many people, which is more important, investment or consumption, communication, or improvement of professionalism? This question should be discussed separately. Compared with consumption, I think investment is more important. The power of investment compound interest is very great. The earlier the investment, the future income will increase exponentially. Assuming an annualized return of 10%, $1 will become $6.70 in 20 years, and $17.40 in 30 years. You see, if you invest 10 years earlier, your investment income will be several times higher. In fact, a large part of the reason why the stock god Buffett can earn so much is that he started very early and accumulated a very considerable initial capital before the age of 30. If he only started investing at the age of 35, he is estimated to be just a small rich man, not an investment master who is invincibly rich. Some people think that the annual income is relatively small, or only 50,000, or only 100,000 US dollars, and they can't save money at all. I think it is still necessary to make an investment plan and invest the funds in the capital market. As mentioned above, it will take time, you will reap the rich returns these funds bring you. As for communication, improving professionalism, etc., I don't think it contradicts investment. Can't you hang out with your classmates, colleagues, boyfriends and girlfriends when you are trading in stocks? Can't it work? 4. How should I start learning? You need to spend a certain amount of energy, master a wealth of investment knowledge, establish your own investment system, and be familiar with the analysis methods of stocks and bonds. This process will be relatively long. Read more, learn more, and experience it in actual combat. As long as you continue to actively practice and learn, you can basically live a good and nourishing life in the stock market. Moreover, investment knowledge and experience can be used for life and can help you make money for life. Okay, that's all for now. You are welcome to leave a message in the comment area to discuss with everyone.